Hold on to your wallet, folks. The financial areas are getting choppy with the latest Liberation Day. On April 2nd, 2025, President Trump announced a 10% universal tariff on all the imports, with certain countries facing even steeper rates. China, for instance, is looking at a hefty 34% on top of existing tariffs. So stock market slides. The Dow Jones Industry Average took a dropping 2,200 points, making it the worst week since 2020 pandemic. The S&P 500 wasn't spared either, plunging 6%, while the Nasdaq entered bear market territory. So the VIX, dubbed Wall Street fear gauge, spiked to a 5-year high, signaling increased market volatility and investor anxiety. So today we are going to cover the concept of VIX. Hello everyone, welcome back to Joey's Business World, where I explain complex business concepts in simple, relatable terms. So the VIX, or Volatility Index, is a real-time market index representing the market's expectation for volatility over the coming 30 days. Think of it as the financial world's mood ring, reflecting investor sentiment and predicting market turbulence. Who brought the VIX to life? The Chicago Board Options Exchange, or CBOE, introduced the VIX in 1993. It was designed to produce a benchmark for expected market volatility and has since become a key measure of market risk. The Chicago Board Options Exchange, or CBOE, is basically Hollywood of options trading, where drama of puts and calls unfold every day. It was founded in 1973 as the first marketplace in the US dedicated just to trade standardized options. Before that, options were traded informally and kind of like of the blank market, risky and inconsistent. The CBOE brought rules, order, and a giant sign that says, "Welcome to serious trading." So fast forward to 1990s, everyone's dancing, music and money in tech stock, but markets are also getting a bit twitchy. Traders wanted to have a way to measure the fear in the market, like a financial weather forecast for mood swing. So in 1993, the CBOE teamed up with the financial wizard, Professor Robert E. Wiley of Duke Universities, who developed a formula based on SP 100 options. Boom, the VIX was born, short for Volatility Index, but most people just call it the fear gauge. It's like a thermometer that tells you how nervous investors are feeling. So a bit of fun fact, the original VIX was based on the SP 100 index, but in 2003 it was updated to reflect the broader SP 500, making it more representative of the whole market. During major crises like 2008 financial meltdown and 2020, which is COVID crash, the VIX shot up like a horror movie, screaming that investors were terrified. The VIX usually chilled around 12 to 20 when markets are calm, but if it goes above 30 plus, that's the financial world's version of a red alert.